Hello everybody, it's Taurus Investing coming at you today with 3 of the best stocks to buy now. If you're new, please hit that subscribe button for me. I greatly appreciate it. Drop a like down below and let me know if you own any of these holdings that we're going to be talking about today. None of this financial advice. Always do your own research before investing. Now, without further ado, I'll be taking a look at Salesforce, Darden Restaurants, and Canadian National Railway. So, Salesforce, if you don't know what they are definitely big into the tech and AI space. You can go on the Salesforce website and actually look at some of the products and stuff that they offer, anywhere from AI, sales, services, marketing, etc. And they have a beautiful looking balance sheet. We got a just free cash flow yield here of 2.42%, dividend yield of 0.56. They announced their first dividend, so now they are a dividend payer. Love it. Take a look here over the last 5 years, up 83.7%. They had a high here of a little bit over 300, and they flirted with it, and then they're back down just a smidge. But I think they have a great path ahead of them. Now we take a look at the revenue, grown at a rate of 24% over the last 10 years. That is awesome. You can pretty much expect upper to mid double digit growth going forward. Now their revenue by segment, another thing that I just love about Qualtrim Insights, you can break this down and see that their revenue is also growing, and each of their categories are increasing over time. This breaks everything down for us. And their performance obligations, again, this is just growing over time, which is beautiful. Free cash flow is just bonkers. It's amazing. It's awesome. This company is growing free cash flow so quickly. EPS, their EBITDA is growing as well. EPS is something that they are working on. Now, they did have a history of issuing shares like crazy, but if you take a look here, they were at $1 billion at one point, and they have nibbled this down to $983 million, and they said that they're going to prioritize returns to the investor in the form of buybacks and a dividend, as they did announce a dividend. And going forward, I would expect double-digit growth from this dividend. So let's take a look at their financials here. They have some debt, $5 billion. They have $14 billion in cash. They could pay us off tomorrow if they wanted to. No problemo. So let's take a look here. Their CapEx, no, they're not CapEx. Their return on capital, ROCE, is increasing as well. This is something that had been kind of in the dumps for a little bit, but this is going up and to the right, headed in the right direction. And they are keeping their CapEx low. There's no giant spikes here, which is another thing that I absolutely love. So, EPS growth on average looks like 605 for 2025. And will be growing to 722 in 2026. So I am pretty sure that that is definitely double digit. Let's divide it out real quick just to be sure. Oh yeah, upper double digit growth with their EPS. Revenue 38.01 billion, growing to 41.95 billion. So again, I think that's right at double-digit growth as well. Let's go ahead and just calculate it. We're here. Let's go ahead. So 38.01 divided by 41.95. Yeah, right at 10%, which is awesome. And that cash flow is going to be falling right in line with it. Next up, we've got Darden Restaurants, or Darden. I'm probably saying that wrong. Just free cash flow yield of 4.81%, got dividend yield of 3.46%, payout ratio of 60%. So they're kind of been hovering around this 140 to 160 area for a hot minute. So it might be a great time for share accumulation. Revenue's been growing at a rate of 5% over the last 5 years. So they did have this little drop off here, so it's probably messing with the overall 10-year chart. Free cash flow has been growing at a rate of 13.7% over the last 10 years. Very nice. EPS should be falling right in line with that. Yep, right at 10%. Their debt is gone. They don't have any debt. They have some cash on hand. Looks like they went ahead and eliminated what little bit debt they had. The capital leases are their buildings and stuff that they have to rent out. So I don't really count that as hard debt. Now the dividend, let's go over here and take a look. Been growing dividend at a rate of 10% over the last 10 years. They did have the COVID dip here. Once the world shut down for a little bit, they did cut that dividend. But if you also notice that they went right back to where they was. So it was at 88 cents a share. They cut it and put it right back where it was, and then it's just off to the races from there. Shares outstanding. It's another place where they shine. Over the last 2 years, been buying back shares at a rate of 3.44%, and I hope that they are continuing to do so. Let's take a look at the quarterly. They are still nibbling at that. Great. And return on capital employed. Usually companies hover around 9 to 10%. This is in the mid double digits, 14.47. Again, they had the 2020 and 2021 dip. A lot of things have that. Expenses, their capex, nothing extreme here, nothing really concerning. You don't see any massive spikes. EPS, 8.59 average for 2024, expected to grow to 9.63. So we'll go ahead and do the math on that really quick. So EPS growth expected to be right at 11%. Let's take a look at the revenue as well. 1141 divided by 1197, and revenue is expected to grow right at 5%. Now, Darden Restaurants, I should have went over this at the main beginning, is a restaurant brand. This is some of their restaurants that they have: Olive Garden, Longhorn Steakhouse, Yard House, Ruth's Chris's Steakhouse, or Roofs, Cheddar's, Capitol Grill, Season 52, Eddie V's, and Bahama Breeze. Now, they do have a little bit of some chaos going on with the whole Red Lobster. Probably going to have to go bankrupt, but you know what? That's just a small piece of what they have going on. Now, next up, we got CNI, Canadian National Railway. They transport goods, and here are some of the things that they transport: automotive, coal, fertilizer. You can go on their website and pretty much it breaks everything down for you. Nice little map here, and it actually gives like a timeline of everything for their transportation times. Now, CNI, I like CNI a lot more than I do CP, Canadian Pacific. I know it's a really popular one amongst people. The reason being is they have their debt under control a little bit better. We take a look here at the 5-year chart, up 36%. Again, a lot of things I feel have been hovering around this like up 20, down $20 area. And this is another one that's just kind of been skipping around here the last couple of years. Just free cash flow yield of 4.72%, dividend yield of 1.95%, payout ratio of 52%. Nice. Revenue's been growing at a rate of 4.76% over the last 10 years. And the free cash flow, 9.14%. EPS growing at a rate of 10.69%. They are buying back shares. Love it. Now their debt, take a look here at the quarterly. Debt is up to $23.32 billion. Their EBITDA was 8.88 as of last year. My general rule of thumbs, I don't like companies that have more than 3 times their EBITDA in debt. That shows if something major was to happen, or if they needed to build capital for something. It would be a little bit harder for them because, if they have a higher debt obligation, it's going to be a little bit tougher on their finances. So the dividend, I don't know why this is here. That's not at all. They didn't issue that. But as you can see here, up and to the right, I think this is probably around like 7 to 9% growth over the long run. And I'm pretty sure they're going to be able to maintain that going forward. Take a look here at the quarterly. They are still nibbling at those shares, which I love. I love when my companies do share buybacks. And they have been doing that at a rate of 2.47% over the last 10 years. And over the last year, over 4%. So they're taking advantage of, when the share price drops, gobble up those shares. Now, as I was saying before the mail arrived and made my dogs go crazy, the return on capital employed is somewhere where they consistently shine. Market averages around 9 to 10%, and they do a really good job of keeping it around 12-15% very consistently over the long term. And again, no big CapEx return, like spikes here or anything that is worrisome. Now, when it comes to their EPS, let's go ahead and calculate this up as well. The average is 971 for 2024, growing to 893 in 2025. That's about a 11.5% growth in EPS. That is amazing. Love to see that. And the revenue average is 17.5 billion and growing to 18.59, which shows right at 6% revenue growth. So good middle single digit on the revenue growth. I expect pretty consistent free cash flow growth going forward, and low double digit growth from their EPS. That's everything I got for you. Hope you enjoyed that. Make sure to hit that like and subscribe button for more. And until next time, take care. See you.